Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is June 18th. We will not be doing a stock pick of the day video tomorrow. The market is closed. This actually may be the last one for the week. I am on vacation the rest of the week, so I may not come back and do one Thursday. I haven't really decided yet. It really depends on what me and the girls have planned for that day. We may spend the day on the lake, so obviously I wouldn't be able to do one if we did that, but we'll see. Today we're going to take a look at Fortis. This is actually a Canadian utility company. Let's jump right in. Now before we get too far in the video, if you would take a moment to hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit the notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know, have you ever heard of Fortis? It is not one that I see covered in the dividend community. Even in the utility company sector, whenever people are talking about them, it is one I was rather interested in whenever I heard about it and started looking into it a little more. So I thought we'd cover it. Drop me a comment down below. Is it one you've ever heard of? Is it in your portfolio? Is it one you're watching or avoiding altogether? We'd love to hear from you. Now, this is the Vested Interest stock screener. This is how I look at a company on a high level to see if I am interested in investing. It's also how I set up the video. So we're going to run through this screener. We'll take a look at the end, see if it meets 5 of 8. If it was a bank, we'd add in price to book, or an insurance company, we'd look at price to book using 1 as fair value, anything under 1 being undervalued, anything over 1 being overvalued. But do not blindly use that 1 as fair value for any company when looking at its price to book. Make sure for other companies out of like the utility sector that we're looking at here, the industrial sector, the consumer staples, or consumer discretionary or information technology sector, those sectors, you want to compare that company to other similar companies that are like it. Like a utility company here, we'd look at, NextEra Energy or DTE Energy or some of the other utility companies that are out there. Now let's jump back over. If you want to know more about this company, check them out at www.fortisinc.com. That's www.fortisinc.com. That is their homepage where I pull this information from. Fortis Inc. has its origin in the formation of St. John's Electric Light Company in 1885 in the province now known as Newfoundland and Labrador. That company eventually became Newfoundland Light and Power Company Limited, which became the first wholly owned subsidiary of Fortis Inc. Fortis was created as a holding company in 1987 with the mission to expand and diversify. And that's really what this company is. It's a holding company with several other companies under its umbrella that own electrical and gas distribution, kind of spread out across the United States, Canada, down in the Cayman Islands, the Turks and the Caicos Islands. So pretty big presence, kind of spread out all over in North America here again, Canada and the United States, with some down in the Cayman Islands and the Turks and Caicos Islands as well. And you can see here some of the companies under its umbrella: ITC, UNS Energy, Central Hudson, Fortis British Columbia, Fortis Alberta, Newfoundland Power, Maritime Electric, Fortis in Ontario, the Caribbean Utilities, I believe that's the one down in the Cayman Islands or the Turks and the Caicos Islands, and Fortis CI. I'm not sure where CI is. That must be another Canadian province up there. So again, www.fortisinc.com. A lot of different subsidies underneath them, and they are primarily energy, electric subsidies, electric suppliers, and gas suppliers. That's what their bread and butter is, with their hands in some renewable energy as well, wind and solar. Now, the reason we're taking a look at them, down 0.82% on the day. We are talking about Fortis Inc. Ticker FTS, again out of the utility sector. Close out the day at $38.46. Looks like they're up slightly in the after hours. 52-week range. Now, this does not have a very big range. It does not move very much at all. Very low volatility on this one. 52-week range as low as $36.30, as high as $43.84. Almost right smack dab in the middle of the high to the 52-week low. And it would be technically within 15% of a 52-week low, though I don't know that's really a good one to use on this one since there's such low spread there. A market cap of $18.961 billion, a beta of 0.19, so very, very low volatility on this one. It does not move much. If you are looking for a utility company with next to no volatility, it's not going to move a whole lot. That's one for you, and it does have a pretty nice dividend yield here. We'll see that in a minute. Beta of 0.19, so very low volatility, 1 being the volatility of the market. Obviously, it's much lower than that. PE, price earnings ratio, $16.87 per share. It's not too high as far as PE. I like around 15 for a utility company. or lower. Earnings per share, EPS sitting at $2.28 per share. Earnings date is coming up July 31st, so tune in if you're interested in watching earnings date or listening to earnings calls or reading earnings reports. I don't do that a whole lot. I think they're a snapshot in time, right? You need to look at them holistically throughout the year, not just one quarter. It is a way to kind of play the volatility. If you have a bad quarter, the price might drop and it might be able to jump in and utilize it that way. But to me, earnings reports don't, they're going to forecast their best earnings report out there and do their best to forecast what they think they can hit. They can fudge the numbers a little bit. I'm involved in forecasting with my company, and we try to paint a rosy picture to our higher ups so that they can paint a rosy picture to the public. I mean, it just is the way it is. You're not going to come out and say everything's terrible, our company is going down the toilet, because that would be bad. That you would not be doing your job trying to protect the company. That's just the nature of executives, vice presidents. I'm a manager, managers and above. That's your job. Your job is to kind of look out for the company. That's just the nature of business. Forward dividend is $1.73 per share. Dividend yield, nice starting dividend yield, 4.46% here. Ex-dividend date was May 16th. Looks like they paid out June 1st. So if you were to buy them now, you would be in line for that next payout, though you're going to have to wait a few months here. And a one-year target, at least according to Yahoo Finance, $40.90 per share. So slight upside as far as the stock price goes. Forward annual, we're going to look at we're going to look at the dividend yield theory. To do that, we look at their 5-year dividend yield average, 3.73%. We compare it to their current 4.46. Over here, 4.46, same number. I know it says forward annual dividend yield. I get that. But that's the current, right? And since it is higher, that speaks to some undervaluation on this one, at least according to dividend yield theory. Now, the payout ratio, we're going to get a couple of different numbers. One from Yahoo Finance says it's under 75% at 73.8. The one at Stock Analysis we're going to look at a little later says it's slightly over. Split it in the middle, it's probably right around 75%. I don't look at utility companies as closely for this. I still like 75% or under. You want to give them a little bit of room to continue to expand their business, pay down debt, make acquisitions if they're gonna, pay out dividends, increase the dividends over time. But these type of companies, utility companies in general, typically pay out a very high payout ratio. They're trying to reward shareholders, and they are a capital intensive business, right? If you have electrical lines and solar arrays and wind farms and gas lines, you're going to have maintenance costs associated with those. So you're also going to see that in the free cash flow. It's wonky. They always look negative. It never looks good as far as the balance sheet and income statement. You need to do more of a deep dive on this one and start looking at stuff like revenues, margins, EBITDA, for these ones here, debt, make sure they're paying down debt, that sort of thing. These are the type of companies you really want to get into the balance sheet and the income statement, because the free cash flow is not going to give you a very good metric here. But payout ratio here, 73.8%. So according to Yahoo Finance, it's under 75% that I look for, but according to Stock Analysis, it's going to be slightly over. We'll see that here in a little bit. Now, looking at free cash flow, like I said, these always look bad. Any utility company, a lot of energy companies you look at are going to be negative, 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 because they have some different criteria as far as tax purposes. They're able to write off a lot of that capital appreciation or capital depreciation, money invested back into the pipelines and electrical lines and that sort of thing. They're able to do some things for tax purposes that other businesses aren't. So they really want to show a negative, right? So that they can try to get some of that money back in tax incentives. 2021, negative $479 million. 2022, negative $791 million. 2023, negative $624 million. Again, I said it's going to look bad. None of them are going to look good. And trailing 12 months, negative $930 million. So that's part of 2023 and part of 2024. That's what the trailing 12 months one is, right? So not very good as far as free cash flow is the way it looks, at least on here. They are repaying debt, but again, remember, just looking at repayment of debt in isolation is not a good way to look at it. You want to take a look at their issuance of debt and how much they repaid, and then subtract the repayment of debt from issuance of debt, and are they taking on more debt than they are repaying? That's what you want. Or are they repaying more debt than they are taking on? That's what you're really looking for. And really, assets over liabilities is another one you want to look at. Debt as well, overall debt. Those are some of the balance sheet and income statement numbers you should be looking at there. Now, jumping over to stockanalysis.com, they have two analysts that have called this a consensus buy. That is not a lot of analysts, and you take analysts with a grain of salt anyway. They are not necessarily the end-all, be-all. They are individuals just like you and me that are doing, a discounted cash flow analysis, looking at the numbers and then finding a price and saying, yeah, is it lower than what I think it should be? Yes, then it's a buy. If it's not, then no, it's a sale, or maybe a hold. But these two are calling it a potential buy. And now I always recommend more than one source. So Stock Analysis and Yahoo Finance are just two sources that I go to for information. You pick any sources that you like. Just make sure you're not blindly looking at just one source. And the reason you want to pick more than one source, because look at this right down here. Price targets were last updated on August 24th, 2023. So they have not updated this at all in 2024 yet, right? These two analysts have not come back in here and said, oh, the updated price targets. So these could be just way outdated and way high. You never know. Right, but this is what their last one was, so we're going to look at it. They have a low of $60.50, which would be a 57.35% increase. They have an average estimate of $61.25, which would be a 59.3% increase. And they have a high estimate of $62, which would be a 61.25% increase. All the while, you can collect that 4+ % dividend yield, and that's really what you're looking for with utility companies. They are a income play, right? You want to get that, generate that income every quarter and rake it in. Retirements really like to look at utilities because utility companies aren't going anywhere, right? And a lot of people are highly unlikely to change their utility company. Some places, like if you're on an island, they might be the only utility company. So we're going to jump into statistics here and look how well they are reinvesting back into their capital. Same thing with these numbers here. I never see good numbers on return on equity, or I won't say never. Rarely do I see good numbers on return on equity and return on invested capital, at least as far as above the 10% that I'm looking for. So you might use this one as well for utility companies. Compare them to other companies in the same sector. But I'm going to use the numbers. Return on equity at 7%. It's below the 10% I'm looking for. Return on invested capital at 4.81% is below the 10% I'm looking for. So this would not get a check mark from me. Now, earnings per share growth, I like 5% projected over the next 5 years or better. They are at 5.24, so they just are above what I'm looking for there. And revenue growth is forecasted at 3.83%. So a nice revenue forecast for them as far as for growth over the next 5 years. Now, are they going to meet it or not? 5 years out is a long way to look out, but we'll see. We're going to take a look at their dividend history real quick before we wrap this one up. Quarterly payer, again, like I said, Yahoo Finance had them under 74 at 73.8, I think it was. This one has them at 76.17. So if you wanted to split the difference and say they're at 75% payout ratio and under, that's great. If you don't want to give them a check, that's fine too. That's really a coin flip. Dividend growth, they are growing at 2.51%. 7 years of dividend growth. Their buyback yield, so they must have been doing some buybacks here several years back, is in the negative. You don't really want to see that. That means they were not very efficiently buying back their own shares, or they may be diluting you slightly as a shareholder if they're giving a stock-based compensation to their employees, possibly. That could be a potential why it's negative as well. And shareholder yield at 2.76%. So shareholder yield being positive is a good thing. Now, these numbers are going to be a little off. It doesn't look like they're growing, but again, remember, this is a Canadian company, so you've got to take into exchange rates. They are growing, even though these numbers might not go consecutively grow from year to year. They're just growing slowly. Back here and I'm not going to really go over it. Currently, they are paying 43 cents per share. I'm not sure if that's showing the cash amount in United States dollars or the Canadian equivalent there. So you'd have to look and see how they're reporting this out. But they are on the March, June, September, December timeframe here. Now, as we wrap this one up, let's run through the screener. We started with understanding the business. That's why you want to go to their homepage. What do they do? How do they make their money? Where are they located? So we looked at that. Growing free cash flow over the last 4 years? No, there never really is. Growing negative, if anything. Growing dividend, yes, they do have it's only slow growth, 2.55%, but it is growing with a high starting dividend yield. I can deal with a slow grower if it has a nice starting dividend yield. Dividend payout ratio of 75% or less. Like I said, this could be a toss-up. Yahoo Finance had it at 73. Stock Analysis had it at 76. So if you wanted to say no check there, I'm not going to argue with you. Check valuation based on dividend yield theory. Currently, potentially undervalued according to dividend yield theory. It is within 50% of a 52-week low, though there is not much there of a margin. It just doesn't move much. Very low volatility on this one. So if you're looking for a utility company with very low volatility, this is one for you. Return on equity and return on invested capital, no check there. And earnings per share growth was right over the 5% I'm looking for. So 1, 2, 3, 4, 5, 6 if you wanted to take out 75% or less, it would be 5. Either way, it would make it on my watch list. Interesting utility company here. Utility holding company with several companies under its umbrella. Again, spread out over Canada, the United States, and down in the Cayman Islands, the Turks, and the Caicos Islands as well. So, interesting company, might be worth a look. And let me know what you think of this one. Is it one you're watching? Is Fortis one in your portfolio? Is it one you're avoiding altogether? I know I have some Canadian watchers out there. Let me know what you think of this company. Are you aware of it? Is it one in your portfolio, as some of the viewers of the channel are Canadian viewers? So I'd love to hear from you guys specifically. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. And drop a comment down below. Join us on this journey to financial freedom. Join the Investing community. Let me know what you think of the video. Let me know what you think of Fortis. Would love to hear from you. With that said, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. And if I don't come back and hit a video on Thursday, have a great week. Have a happy Juneteenth holiday there. Hopefully you guys get the day off. We have the day off, and I just happen to take the Thursday and Friday off, so I'd have a nice long weekend. And like I said, Thursday we may be spending some time out on the jet skis out on the lake, so we'll see. But again, thanks for stopping by. We'll see you in the next one. I'm not a financial advisor. You can read through the rest of this. Starting to get a little long on this one, but again, not a financial advisor, and definitely not your financial advisor, so make sure you're doing your own research.